In this video, I'll walk you through the most important input parameters of the Timeless Trend Trading Expert Advisor. I will explain the default value of each parameter, what it does, and how it can influence the behaviour of the strategy and the shape of the equity curve. Let us start with the general section. The first parameter is called magic number. The default value is 1444. The magic number is the internal ID that the expert advisor uses to recognize its own trades. If you run several expert advisors on the same account, you should give each of them a different magic number so that they do not accidentally manage each other's positions. This parameter itself does not change the performance of the strategy, but it is essential for clean portfolio management. Now we move to the risk and money management section. The first parameter here is risk per trade. The default value is 1.0. This is the basic risk unit that the expert advisor uses for position sizing. Depending on the following settings, it is interpreted either as a percentage of your account or as a fixed amount. If you increase this value, both profits and drawdowns will grow. If you reduce it, the equity curve becomes smoother, but overall returns are smaller. The next setting is risk in percent of account size. The default value is set to true. When this flag is true, the risk per trade value is interpreted as a percentage of the account. When it is false, the risk is interpreted as a fixed amount, depending on the chosen money management mode. Using a percentage-based risk makes position size scale naturally with the account and gives the equity curve a compounding shape. The money management mode parameter controls how this risk value is applied. The default option is risk in percent of balance. Other internal modes are risk in percent of equity, constant risk in currency, and constant lot size. With the default mode, the expert advisor looks at the current balance and risks a fixed percentage of that balance on each new trade. This leads to an equity curve that grows and shrinks proportionally with the account. If you switch to risk in percent of equity, the expert advisor also reacts to open profits and open losses, which can make position sizes more dynamic. If you use constant risk in currency or constant lot size, the position size does not change when the account grows or falls. In those fixed modes, drawdowns become easier to interpret in absolute terms, but you lose some of the natural compounding behaviour. Now we look at the parameter called maximal drawdown before min lot. The default value is minus 99%. This parameter activates an automatic de-risking mechanism that scales your lot size down as your drawdown gets deeper. It does not suddenly cut the lot size only when this exact drawdown is hit. Instead, the expert advisor reduces the lot size gradually and linearly on the way to this limit. Imagine your maximum drawdown limit is minus 50%, and your current drawdown on the account is minus 10%. You have already travelled 10 of 50% of the allowed drawdown path. That is 20% of the way. In this situation, the expert advisor will already reduce the risk of new trades by roughly 20% compared to the original risk setting. So it scales down linearly as drawdown increases. If you want to almost completely disable this mechanism, you should set a very distant value, such as minus 999%. Then even relatively large drawdowns hardly reduce your position size. If you choose a relatively small value together with a high risk per trade, you will see a very characteristic behaviour in the equity curve. In profitable phases, the expert advisor trades with full risk and the curve rises steeply. As soon as a losing phase starts and the drawdown grows, the protection kicks in and the expert advisor quickly goes down to minimal lot size. It then stays in this defensive mode for a while and only slowly tests if the environment improves. Once the drawdown is recovered and conditions look better, the expert advisor ramps up the risk again and the equity curve jumps to a new level. The result is a stair-step pattern, where periods of strong growth are interrupted by flat phases of capital preservation. Now we move to the swap and conservative assumptions section. The parameter use additional swap buffer has a default value of false. When you switch this to true, the expert advisor uses an extra negative swap component in its internal simulations. This extra swap is applied proportionally over time in a similar way as real swap is calculated for Forex and CFD positions. It makes your backtests and forward simulations more conservative by assuming that overnight financing is slightly more expensive than the broker currently reports. The next input is swap impact in CAGR%. The default value is 3.0%. This number defines how large this additional financing cost is on an annualized basis. The expert advisor spreads this effect over the life of the trades and subtracts it from the simulated equity curve. This is especially important when you backtest stock CFDs. At some brokers, for example IC Markets, the swap calculation for stock CFDs is not always fully reflected in the standard backtest environment. To get realistic or even slightly conservative simulations for stock portfolios, you should enable the additional swap buffer and enter a value that corresponds to the real annual financing cost, for example around 2.6 to 3%. When you do this, the equity curve you see in the backtest is much closer to what you can expect in live trading with stock CFDs. Next, we look at the deposit plan simulation, which represents a simple dollar cost averaging model. The parameter monthly deposits has a default value of false. When you turn it on, the expert advisor will simulate adding fresh capital to the account once per month. This does not change individual trade quality, but it changes the shape of the equity curve because the strategy receives new capital over time. Monthly deposit amount in account currency has a default value of 200. This defines how much money is added each month when the monthly deposit option is active. A larger amount makes the account grow faster in periods of positive performance and helps you see how your own savings plan could interact with the strategy. Weekly deposits has a default value of false, and weekly deposit amount has a default value of 50. They work in the same way as the monthly settings, but with a weekly rhythm. Using weekly or monthly deposits is useful if you want to simulate realistic cash flows from a salary or other regular income. Now we move to the timeframe and trading session section. The parameter calculation timeframe has a default value of 1 hour. This setting does not define the timeframe of the trading signals or the indicators. Those are implemented directly inside the code. Calculation timeframe simply defines the basic time step that the expert advisor uses to run its full calculation cycle. If you choose a shorter timeframe, for example 1 minute, the expert advisor will execute its logic much more often, which makes backtests slower and heavier. If you choose a higher time frame, such as 1 hour or 4 hours, you can simulate many years of data very quickly, because the expert advisor only performs a full calculation once per bar on that time frame. So this setting is mainly about the performance and speed of simulations, not about changing the core logic of the strategy. The parameter calculate on bar close only has a default value of true. When it is true, the expert advisor performs its main calculations only at the close of each bar on the chosen calculation timeframe. This again is a performance optimization. It reduces the number of times the expert advisor processes new data and therefore speeds up backtests and forward tests. It does not change the mathematical logic of the strategy. It only changes how often that logic is evaluated. Next, we have trading start hour and trading end hour. The default start hour is 2 and the default end hour is 15. These parameters define the time window during which the expert advisor is allowed to place new pending orders in the market. From the start hour onwards, the expert advisor can send new stop orders and limit orders. After the end hour, it stops sending new orders. Whether these orders actually become trades is then decided by the market, not by the time settings. If price reaches the order level, the pending order turns into a position. even if that happens outside the trading window. The parameter pending order expiry in hours has a default value of 20. It defines how long a pending order stays active after it has been placed. If the order has not been triggered within that number of hours, it is removed automatically. By combining trading end hour with pending order expiry, you can control for how long new orders can still be activated after the search window is closed. The strategy itself is designed as a swing trading approach with holding periods of several days or even weeks. Overnight exposure is therefore part of the core idea and is not disabled by these time settings. The time window simply defines when the expert advisor is allowed to place new orders. Now let us look at the symbols and portfolio construction section. Trade multiple symbols has a default value of false. With this default setting, the expert advisor trades only the symbol of the chart it is attached to. If you change this to true, the expert advisor will use the symbol list input and manage a multi-asset portfolio. This allows you to diversify across many markets and can make the equity curve smoother through diversification effects. The symbols list parameter has a default value that includes a broad mix of assets. For example, oil contracts, cryptocurrencies, gold and silver pairs in several currencies, index CFDs, and classic forex pairs. This diversified list is a good starting point because different assets tend to trend at different times. In my own tests, portfolios of large technology stocks have also performed very well with the underlying logic. If you create a list of major tech names or so-called FANG and Magnificent Seven stocks, the strategy can capture their strong long-term momentum very effectively. So the symbol list is a powerful tool to adapt the expert advisor to different market universes. The parameter number of top momentum symbols has a default value of 5. From the full symbol list, the expert advisor ranks all instruments by their relative strength, and then trades only the strongest ones. With the default setting, only the 5 symbols with the best momentum are eligible for new trades. If you decrease this number, the expert advisor focuses more on a few top trends, which can increase both return and volatility. If you increase it, the expert advisor spreads trades across more instruments, and the equity curve usually becomes more stable. Next, we move to the exit and trade management section. The exit strategy parameter controls how open positions are closed and protected. The default mode is called price action stop. Other modes exist in the code, such as no price action stop after trailed above break-even, take profit after first profitable close, and take profit after profitable close above previous highest price. With the default price action stop mode, the expert advisor analyzes recent price structure and moves the stop loss dynamically as the trend evolves. This helps to lock in profits while still giving winners enough room to grow. More conservative modes lock in profits earlier and will often reduce drawdowns at the cost of cutting some trends shorter. So the choice of exit mode has a strong influence on the volatility of the equity curve and on how much of each trend you capture. Trailing evaluation period has a default value of 1 day. This defines how often the expert advisor revisits its trailing logic and potentially adjusts stops. With a daily period, stops are only updated once per day in the trailing logic. If you reduce this period, the expert advisor will adjust stops more frequently and can protect profits faster, but it may also exit some trades too early. If you increase it, trades are allowed to fluctuate more and long trends are captured more fully, which can improve long-term growth but also increases temporary drawdowns. Now we come to the market filters section. Use range filter has a default value of true. When this filter is active, the expert advisor analyzes the recent range behavior of the market using a specified count of range bars. In certain unfavorable conditions, it can block new entries or reduce activity. The goal is to avoid environments where the price action is too flat or too choppy, because these periods tend to produce many small losing trades. By filtering these phases, the range filter can significantly clean up the equity curve. Use volatility filter has a default value of false. If you turn it on, an additional volatility-based filter is applied. This can, for example, avoid very low volatility environments where breakouts fail, or extremely high volatility spikes where spreads and slippage become dangerous. Again, the effect on the equity curve is usually fewer trades and a more stable performance profile. Number of range bars count has a default value of 7. This defines how many range bars the range filter looks at when it evaluates the current market condition. Smaller values make the filter react quickly to recent changes, while larger values make it smoother and slower. Adjusting this value lets you fine-tune how sensitive the filter is. Use Williams %R filter has a default value of false. If you enable it, the strategy adds another layer of filtering using the Williams %R oscillator. This can be used to avoid extremely overbought or oversold zones, or to prefer certain parts of the momentum cycle. Williams %R look-back period has a default value of 24 and defines how many periods are used to calculate the oscillator. Short lookbacks are more reactive and noisy. Long lookbacks are more stable. Invert Williams signal has a default value of false. With the standard setting, the filter is used in a typical way. If you set it to true, the signal logic is inverted. This can effectively transform the character of the strategy from a more mean reversion style towards a more breakout or trend-following style, which again changes the shape and volatility of the equity curve. Finally, we look at the trend filters based on moving averages. MA filter timeframe has a default value of 1 day. This defines on which timeframe the moving averages are calculated, independent of the timeframe used for the main signals. Using the daily timeframe gives a stable view of the higher timeframe trend and helps the expert advisor stay aligned with the broader market direction. MA type has a default value of exponential. All moving averages used by the filters will be of this type. An exponential moving average gives more weight to recent prices and therefore reacts faster to trend changes than a simple moving average would. This affects how quickly the expert advisor recognizes new uptrends or downtrends. Use fast MA filter has a default value of false, and the fast MA period has a default value of 50. When you activate the fast MA filter, the expert advisor will only take trades that are consistent with this faster moving average. This makes the strategy more sensitive to short-term trends and can speed up the response to regime changes. Use mid-MA filter is also false by default, with a mid-MA period of 100. When enabled, this filter adds a medium-term trend condition. It is useful if you want the expert advisor to trade only when both the shorter and the medium-term trend are aligned. Use slow MA filter has a default value of false, and slow MA period has a default value of 200. When this filter is turned on, the expert advisor will only trade in the direction of the long-term trend, as defined by the 200 period moving average on the chosen moving average timeframe. This usually reduces the number of trades, but can significantly stabilize the long-term equity curve, because most trades are then opened in the direction of the dominant trend. To close this explanation, it is important to note that all of these inputs and filters are only the visible part of the logic. Inside the expert advisor, there are many more calculations and conditions that run on every evaluation step. They are based on statistical and scientific research about how financial markets tend to behave over decades and even centuries. Concepts such as momentum, the January effect in equities, and the 200-day moving average have been widely studied and show persistent edges. Timeless trend trading combines several of these robust ideas into one systematic framework. The inputs you see here give you control over risk, capital allocation, and the way the strategy adapts to different market environments, while the deeper logic works in the background to identify and filter trades in a disciplined and evidence-based way. I hope this walkthrough helps you understand how timeless trend trading works under the hood and how you can tune it to match your own risk profile and investment goals.